Silver recently experienced its largest one-day drop since 1980. That headline alone is enough to create panic. When people hear biggest drop since 1980, they immediately think of market tops, crashes, and long bear markets. But serious market analysis is not about headlines. It is about structure. It is about momentum. It is about understanding whether something actually broke or whether only sentiment was shaken. Over the past 2 years, gold has performed strongly. Many investors who stayed long gold have been rewarded. Silver, however, ran much faster in a shorter period of time. It surged aggressively, moved quickly, and attracted late buyers who feared missing out. When a market rises too far too fast, a pullback is natural. The real question is not whether silver dropped. The real question is, did that drop damage the long-term trend? From a structural perspective, nothing important was broken. Long-term momentum trends remain intact. When major market tops form, they usually leave clear technical damage. Momentum structures crack. Long-term trend lines break. Multi-year support levels fail. None of that has happened here. What we saw was a violent but short-lived correction that lasted roughly a day and a half. Most of the selling pressure occurred within hours, not weeks. This is important. True bear markets do not begin and end in a few hours. They develop with structural deterioration. In past major turning points like 2011 or the 2015 lows, there were clear momentum patterns signaling weakness or strength. Today, those warning signs are absent. That suggests this move was more about emotional flushing than structural collapse. Another powerful factor to examine is relative performance. Silver is not moving in isolation. When we compare silver to gold and gold to the broader equity market, we see something important. The macro trend of monetary metals remains strong. Gold miners, gold itself, and silver all sit within a broader bullish structure. Inside that group, silver has been outperforming gold. Even after the recent drop, silver has still outperformed gold over longer time frames like 6 months and 1 year. That relative strength matters. When one asset consistently performs better than another within the same sector, it often signals leadership. And in bull markets, leaders tend to correct sharply, but then continue higher. Many investors panicked during the drop and assumed the top was in. But markets rarely end without warning. Most major tops show clear breakdown structures before price collapses. Here, there was no major structural break. What broke was confidence. And sometimes, resetting confidence is exactly what a bull market needs before continuing higher. We must also understand that silver has spent nearly half a century trading inside a wide range, roughly between single digits and the $50 area. For decades, it moved back and forth while many other commodities experienced large repricings. When an asset stays trapped in a long range for that long, the eventual breakout can be explosive. Markets do not adjust slowly after decades of compression. They reprice violently. This recent surge, followed by a sharp correction, may be part of that repricing process. When markets shift from an old reality into a new one, they often move in dramatic bursts. It is not a smooth staircase. It is a shock adjustment. From a long-term technical perspective, silver's breakout relative to gold is especially important. When we divide the price of silver by gold and study that ratio on a monthly chart, we see a clear multi-year ceiling that has now been broken. That breakout signals that silver is not only rising, it is gaining strength relative to gold. Historically, when silver begins outperforming gold after long periods of underperformance, it often signals the acceleration phase of a precious metals bull cycle. And that is why many analysts see this pullback not as a warning, but as an opportunity. Now, this does not mean volatility will disappear. Silver is naturally more volatile than gold. Gold is larger, more stable, and has a 3,000-year monetary reputation. Silver, while also monetary, reacts strongly to both investment demand and industrial demand. That dual identity creates sharper price swings. But volatility alone does not equal weakness. It simply means the asset moves faster in both directions. For investors who understand structure and timing, volatility can create opportunity instead of fear. So the core message of this first part is simple. The biggest one-day drop in decades did not break the long-term structure. Momentum remains intact. Relative performance supports further upside. And when a market that has been trapped for 50 years begins to break free, the adjustment is rarely quiet. Now let us talk about the big question everyone is asking. How high can silver really go? When people hear projections like $300, $400, or even $500 silver, they immediately say it sounds crazy. But markets do not move based on what sounds comfortable. They move based on structure, liquidity, and revaluation cycles. To understand the potential upside, we must step back and look at history. Let us start with gold, because gold is the leader of the monetary metals. Since gold was fully legalized for trading in the mid-1970s, it has experienced two major bull markets. From the 1976 low to the 1980 peak, gold increased roughly 8 times in value. Then after a long consolidation, from the 2001 low to the 2011 high, gold again rose approximately 8-fold. Different time spans, same magnitude. That is not random. That is structural. Now look at the 2015 low in gold around $1,050. Even after the strong rally in recent years, gold has not yet matched the 8-fold expansion seen in prior cycles. If gold were to simply repeat the same historical performance multiple, it would imply levels dramatically higher than most current expectations. This is not about prediction. It is about pattern recognition. Why does this matter for silver? Because silver historically amplifies gold's moves. When gold enters powerful bull phases, silver tends to outperform on a percentage basis. That is not speculation. That is historical behavior. Let us examine the silver-to-gold ratio. Last year, silver was trading near 1% of gold's price. That is historically very low. During the 2011 bull market peak, silver reached above 3% of gold's price. During the 1980 spike, it briefly reached around 6% of gold's price. Today, after the recent surge, silver moved above 2% relative to gold. This is important. If gold continues higher and silver simply returns to 3% of gold's price, which it has done before, the implied silver price rises dramatically. And if it approaches levels seen during historical extremes, the numbers become even more aggressive. Now, some people argue that history cannot repeat, but markets often rhyme. When assets spend decades underperforming and then begin to outperform, the adjustment phase can be very fast. We saw this behavior in other commodities. For example, copper traded within a narrow range for decades before suddenly breaking into a new pricing regime in the mid-2000s. The move was fast and powerful. It did not gradually climb for 10 years. It revalued quickly. Silver has spent nearly 50 years, mostly between roughly $4 and $50. That is an extremely long compression period. When such long-term ranges break, the traditional arithmetic price targets often underestimate the move. On a simple arithmetic chart, if you measure the thickness of that old range and add it to the breakout level, you might get targets near $90 or $100. Interestingly, when silver recently approached the mid-90s area, it faced heavy selling. That is because many traders were using that traditional measurement. But here is where it gets more interesting. When we look at silver on a logarithmic scale, which measures percentage moves instead of dollar moves, the structure looks very different. The range from roughly $5 to $50 was not just a $45 move. It was a 10-fold increase. If a similar 10-fold structure projects forward from the breakout area, the numbers extend far beyond $100. This does not mean silver must go there tomorrow, but it shows why the move could be far larger than conventional thinking suggests. There is also the monetary factor. Over the last decades, global money supply expansion has been enormous. If we compare monetary aggregates like M2 from previous silver peaks to today's levels, the increase in currency supply is massive. If silver were to reflect similar real purchasing power as in prior peaks, nominal prices would need to be significantly higher just to match inflation-adjusted comparisons. Another important dynamic is the speed of repricing. When markets shift from an old suppressed range into a new reality, they rarely do so in small, polite steps. They move in what can only be described as tantrums, sharp rallies, violent corrections, then another sharp rally. This is typical behavior during structural transitions. We also need to address volatility. Many investors prefer gold because it moves more steadily. Silver, in contrast, can move 10% or more in a single day. Recently, it was up dramatically in early weeks, then dropped 30% in one day. That kind of move is uncomfortable, but volatility alone is not bearish. It reflects liquidity, positioning, and leverage in futures markets. Silver is a smaller market than gold. Therefore, capital flows move it more aggressively. For investors with a 6-month or longer perspective, volatility can be the price paid for potential outperformance. The key question is timing. If someone buys at the emotional top after a massive surge, they may experience pain during corrections. But if someone enters during structured pullbacks within a broader breakout phase, the risk-reward profile improves significantly. From a structural perspective, the breakout in the silver-to-gold ratio that occurred in late November was critical. That marked the beginning of what appears to be a multi-quarter surge phase. The recent correction came earlier than expected, but it has not invalidated the breakout. Short-term momentum indicators are already stabilizing. Daily momentum is crossing back into positive territory. Weekly triggers suggest that a move above certain near-term levels could reignite upside acceleration. This means the correction may have already served its purpose, resetting sentiment without destroying structure. In summary, the idea of silver entering the hundreds is not based on emotion. It is based on historical cycle magnitudes, relative performance against gold, long-term breakout structures, and monetary expansion comparisons. Whether it reaches $250, $300, or beyond depends on how aggressively the repricing unfolds. But dismissing the possibility simply because it sounds extreme may be a mistake. Now let us slow down and talk about risk, timing, and positioning, because no bull market moves in a straight line, and no opportunity comes without volatility. The biggest mistake investors make in fast-moving markets like silver is not understanding where they are in the cycle. Silver recently dropped 30% in a single day. That sounds terrifying. The last time we saw something similar was in 1980, and after that massive spike, silver eventually collapsed over the following months. So naturally, people ask, could this be the same situation? The answer depends on context. In 1980, silver had already completed an extreme multi-year blow-off move. It was deep into its surge phase. Speculation was wild. Positioning was extreme. When the reversal came, it came after a mature advance. Today, we are not 6 months into a parabolic move toward $400 or $500. We are only a short time into a breakout phase that began when silver decisively outperformed gold on a multi-year relative basis. That distinction matters. If silver had already reached $300 or $400 and then dropped 30%, that would be very concerning. But dropping 30% early in a structural breakout is different. It looks more like a violent correction inside a larger upward repricing, not the end of a mania. Markets that are transitioning into new price realities often behave this way. They surge strongly, shake out weak hands, then continue higher. It is uncomfortable, but it is common. Now let us address the psychological side. Gold feels safer. It moves slower. It has a larger market. It is widely held by central banks. Silver, on the other hand, feels unstable. It can rise 70% in weeks and then drop 30% in hours. That volatility scares investors. But from a 6-month to 12-month investment perspective, silver currently shows stronger relative performance metrics than gold. When we compare silver to gold over the past year, silver has more than doubled gold's percentage gain, even after the correction. That tells us leadership is shifting. Volatility does not mean weakness. It means acceleration. The key question for investors is not, is silver volatile? The key question is, did the structural breakout fail? And based on long-term momentum analysis, the answer is no. Nothing critical has broken. No multi-year support has collapsed. No major momentum line has cracked. Short-term technical triggers are already improving. Daily momentum has crossed into buy territory again. Weekly momentum suggests that if silver moves just a few dollars above recent highs, additional upside confirmation will occur. That means the market is attempting to recover quickly from the shock. However, discipline is critical. Chasing vertical spikes is dangerous. Entering during structured pullbacks is more rational. The recent drop may represent exactly that kind of pullback for those who missed the first move. This is not about gambling. It is about positioning within a macro shift in monetary metals. Now let us step back and look at the bigger environment. Global debt levels remain extremely high. Government bond markets are under pressure. Inflation has not disappeared. Central banks continue managing liquidity carefully. Confidence in fiat systems is not collapsing, but it is being questioned more openly. In such environments, gold typically leads, silver then accelerates, and miners often amplify both. Many investors focus only on price charts, but capital flows tell a deeper story. Central banks have been increasing gold reserves over the last decade. Physical demand remains strong globally. At the same time, paper futures markets can create sharp short-term distortions because they are heavily leveraged. This explains why metals can drop violently even when long-term fundamentals remain intact. The important takeaway is this: temporary futures-driven volatility does not necessarily equal long-term weakness in physical demand or macro structure. Now, for our community at Gold Silver Scope, this is the moment where discipline matters most. If you believe in the structural breakout thesis, then corrections are part of the journey. If you are entering fresh positions, risk management is essential. Never allocate capital you cannot afford to see fluctuate. Silver is powerful, but it is not gentle. And let me add a small but important disclaimer. This discussion is for educational and informational purposes only. It is not financial advice. Every investor must do their own research and understand their own risk tolerance before making any investment decisions. If you are serious about understanding gold and silver beyond headlines and hype, make sure you stay connected with Gold Silver Scope. We focus on structure, cycles, and long-term macro shifts, not emotional reactions to daily price swings.